Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So, what if I told you that the impenetrable mathematical locks securing basically trillions of dollars in global wealth currently have a known expiration date?
Yeah, it sounds like science fiction, right?
It really does. Or
Hmm.
or even the idea that the traditional stock market you interact with every day is like quietly gutting its entire back-end infrastructure so it can move at the speed of light.
Right. Well, we're looking at a monumental collision of two massive forces here. I mean, on one side, traditional finance is undergoing the most aggressive technological upgrade we've seen in decades.
Yeah.
And then on the other side, you've got an entirely new class of computing that threatens to just, break the very cryptography that makes all this modern financial stuff possible.
Totally. And that's why today we're taking you on a special deep dive into the hidden operating system of money. If you're listening to this, you probably want to know how the gears of the American economy are actually turning behind the scenes, right? Free of all the
Yeah.
confusing Wall Street jargon.
Exactly.
So, based on recent analysis from April 8th, 2026, we're looking at some heavy data. We've got reports from the SEC, the Federal Reserve, and this landmark white paper from Google Research. Our mission today is to just cut through the noise of these tech shifts. We want you to be empowered by the data, not overwhelmed by it.
And, I think a fantastic place to anchor this whole discussion is how traditional money actually moves today. Because most people assume, well, they think that when they open an app on their phone, tap buy on a share of Apple stock, and see it in their account, the transaction is just finished.
Right. I always pictured it as like a direct handoff. I give you my money, you hand me the stock certificate, and we just walk away.
Yeah, but looking at the data, the reality of the traditional financial system is way more like a bureaucratic labyrinth. When you click buy, you are really just kicking off a multi-day process.
Right, involving brokers and clearinghouses and custodian banks sending all these messages back and forth just to verify who owns what. And that process historically takes, what, 1 to 2 business days to actually settle?
Exactly. And that delay creates what the industry calls settlement risk.
Oh, wow.
Because in that 1 or 2 day window, I mean, a bank could fail, a buyer could default, or you could even have a massive market crash. So the friction in that system ties up trillions of dollars globally.
Just to act as, like, shock absorbers for those delays.
Right. Institutions have to keep mountains of cash on hand just sitting there.
Which brings us to the first major shift we need to talk about, which is tokenization. And let's be super clear about what this means for you as a beginner investor.
Yeah.
Wall Street isn't doing this to play around with, risky meme coins or invent a new crypto casino.
No, not at all.
Under President Trump's current regulatory landscape, agencies like the SEC have officially defined tokenized securities. And the Fed, the FDIC, and the OCC, they've all agreed to treat them like traditional assets for banking capital rules.
Right. The regulatory clarity is totally the catalyst here.
Yeah, and the DTCC, which is the massive clearinghouse that processes basically all stock trades in the U.S., they're prepping for a huge rollout late this year in 2026.
Yeah, the SEC drew a really hard line. They clarified the difference between a synthetic token, which just, mimics a stock's price and sits in this weird regulatory gray area, and true tokenization.
Where the actual legal ownership record is natively on a blockchain.
Exactly. Wall Street wants the latter. They want the existing legal framework operating on vastly superior technological rails.
In the past, I tried to wrap my head around this by thinking about upgrading a city's water pipes. I thought Wall Street just wanted to replace their slow, rusty iron pipes with high-tech fiber optics so the money flows faster.
That's a good way to look at it initially.
But looking deeper at the mechanics, it's way more fundamental than that. They aren't just laying faster pipes. They're eliminating the water treatment plants entirely.
I love that analogy. Yeah, that is a highly accurate way to frame it. The water treatment plants in your analogy are those central clearinghouses and intermediary banks.
Right, so instead of water passing through 5 different checkpoints to be purified and verified, tokenization creates a direct peer-to-peer system using smart contracts, which are basically just, self-executing lines of code.
Right.
If I have the cash and you have the asset, the code swaps them instantly. There's no middleman needed to oversee the exchange.
And that leads directly to the primary institutional motivation here, which is collateral deficiency. I mean, it is the driving force behind this entire movement.
So it's not about day trading 24/7 like the crypto bros do.
No, no. Imagine you're a massive financial institution with billions of dollars tied up in active trades. You're required to post collateral, basically a huge security deposit, to prove to the market you can cover your bets. Well, in the old slow system, moving that collateral from point A to point B takes time, meaning that capital is essentially frozen in transit.
It's just dead money. It isn't earning interest. It's just sitting in a digital armored truck stuck in traffic.
Precisely. Now look at what giants like Franklin Templeton are doing today with their tokenized money market fund. It's represented by a token called BNGI.
Oh, I've seen that in the data.
Yeah, it's a traditional, safe money market fund that yields interest. But because it's tokenized on a blockchain, it moves instantly. And in early 2026, major crypto exchanges started integrating traditional assets like this into their institutional collateral structures.
So an institution can use an interest-bearing asset as their security deposit, and they can literally teleport it across the globe at the speed of light at the exact millisecond they need it.
Exactly. They eliminate the traffic jam, they free up billions in capital, and they earn yield the entire time. The friction is completely gone.
Wow. I mean, that is a massive leap forward for market efficiency. But, whenever you remove friction from a complex system, you invariably introduce new types of fragility.
Oh, absolutely.
Which naturally pivots us to this massive flashing caution light from the International Monetary Fund. According to their April 2nd analysis, the IMF actually acknowledges the brilliance of what they call atomic settlement.
Right, that indivisible instant swap of cash and asset we were just talking about.
Exactly.
Yeah.
But they are incredibly worried about the concept of continuous liquidity, meaning markets that literally never close, 24 hours a day, 7 days a week, 365 days a year.
Yeah, the IMF's concern is deeply rooted in the velocity of financial contagion.
How so?
Well, in our traditional system, if a massive financial crisis kicks off in Asian markets overnight, the fact that American markets are physically closed acts as a natural firewall.
Right.
It gives regulators time to wake up, assess the damage, coordinate a response, and, maybe arrange emergency funding before the opening bell rings in New York.
Okay, wait, hold on. Let me push back on that logic. Because I see a glaring flaw in the IMF's stance here, and it's something heavily debated in the research. Doesn't closing the market for the weekend actually create a more explosive, dangerous situation?
Right.
Like, let's say a major geopolitical shock happens on a Saturday afternoon, right?
Yeah.
A sudden conflict breaks out, or a vital supply chain just collapses. Under the current rules, if you hold those assets, you are completely paralyzed.
Yeah, you're stuck.
You have to sit on your couch, watching the news for 48 hours, absorbing all this risk, and you can't touch your portfolio until Monday morning. Isn't it better to adjust immediately?
You are echoing a very strong argument put forward by industry leaders. Christopher Perkins talks about this a lot. The counter-argument to the IMF is exactly that forced market closures don't eliminate risk, they just bottle it up.
Right.
When the bell finally rings on Monday, that bottled-up panic just explodes in the form of massive, violent price gaps. So in theory, a continuous 24/7 market allows investors to digest news and adjust risk smoothly in real time.
So it allows the market to be a pressure release valve instead of a pressure cooker.
That is the theory, yes. But the mechanical reality of how these new systems operate introduces a pretty lethal caveat.
Oh.
A 247 market only functions safely if the underlying market structure is built to support it. If you have smart contracts completely automating trades and executing margin calls instantly, you also need automated safety nets.
Like circuit breakers.
Exactly. Pre-programmed algorithms that halt trading if a single asset drops too far too fast.
Because otherwise, there's no human being at the wheel to say, hey, this price drop is a glitch. Let's just pause.
Right. And even more critically, you need deep liquidity provided by market makers who are awake and fully capitalized on a Sunday morning.
Which doesn't always happen.
No. If an automated smart contract detects that your portfolio has fallen below its required collateral, it will instantly liquidate your assets to protect the network. And if there are no buyers on the other side of that automated sale because it's, say, 3:00 a.m. on a Sunday, the price just free falls. That triggers another smart contract to liquidate someone else, creating this cascading domino effect.
Wow, wiping out billions in value in seconds. So speed without structural safety rails doesn't create efficiency. It just creates high-speed flash crashes.
Exactly. It's a terrifying mechanical reality.
Yeah, we're basically upgrading the plumbing to flow at the speed of light, but if a pipe bursts, when no one is at the treatment plant, the entire city just floods instantly.
That's spot on. And, while traditional Wall Street wrestles with how to safely implement these fast blockchains, The native digital asset world is facing a completely different existential nightmare.
Right. Which brings us to the second major shift in our deep dive today. We're moving from the risks of market structure to the fundamental breakdown of cybersecurity, the quantum computing threat.
This is where it gets really crazy.
Yeah. Based on the latest Google research published in March 2026, the mathematical foundation that secures virtually all digital wealth today has a rapidly approaching expiration date.
Right. The specific math is called elliptic curve cryptography.
And Google has officially shifted its internal defense timeline down to the year 2029. And Nature magazine recently corroborated this, stating the threat of a quantum break could arrive within this decade.
The shift in that timeline is jarring. I mean, for years, physicists assumed we would need incredibly massive, unstable quantum computers containing millions of physical qubits to break this encryption.
But the Google white paper changed that.
Entirely. They revealed a leap in error correction and efficiency. They estimate that cracking this code might only require 1,200 to 4,450 logical qubits.
Oh, wow.
Yeah. Depending on the architecture, that means the physical machine required to break the global financial locks is roughly 20 times smaller and easier to build than anyone previously believed.
Okay, let's translate that into an everyday scenario so you, the listener, can understand how a quantum computer actually bypasses these defenses. Imagine a giant, impenetrable bank vault, right? Traditional hackers use regular computers to essentially try every possible combination on the vault's titanium padlock. It's a brute force attack. But because the combinations are so mathematically complex, trying every single one would take a normal supercomputer billions of years. So we feel safe.
Right. But a quantum computer does not try every combination. It doesn't use brute force at all.
That is the mind-bending part to me.
Yeah.
Instead of guessing the numbers, a quantum computer uses a completely different set of physics, specifically something called Shor's algorithm, to basically X-ray the lock. It looks at the mathematical shape of the tumblers, finds the underlying periodicity of the numbers, and instantly 3D prints the exact master key to open it.
It's a phenomenal analogy.
The criminals realize they don't need a massive drill. They just found the blueprints to bypass the lock entirely.
Exactly. It weaponizes the underlying math against itself. Now, if you spend time in digital asset circles, you'll often hear a persistent myth designed to downplay this threat. People claim that when quantum computers arrive, the only thing at risk is Satoshi Nakamoto's wallet.
Right, the anonymous creator of Bitcoin. There are roughly 1 million Bitcoins sitting in those original wallets, completely untouched since 2009. The narrative I always see is, well, if quantum hackers steal Satoshi's coins, the market might dip, but the rest of us are totally fine.
But the data paints a vastly different and much more systemic picture. While Satoshi's coins are indeed vulnerable, the recent analysis shows over 6.7 million Bitcoin are currently sitting in highly vulnerable addresses.
6.7 million. Why so many?
It's due to a mechanical feature called public key exposure.
Okay, I really want to break down exactly how this exposure happens, because this is where the theoretical physics turns into a practical robbery for regular people. When you just hold digital assets in a wallet, your mathematical lock, your public key, is hidden behind a cryptographic mask called a hash. You're invisible. But the moment you decide to actually use that wallet, say you buy a cup of coffee with Bitcoin, you have to prove you own the money. To do that, the network forces you to take off the mask and reveal your public key to the entire world to verify the transaction.
And here is the catch. That transaction doesn't clear instantly. It goes into a waiting room called the mempool.
Yeah. The mempool is kind of like a glass room where your unconfirmed coffee purchase sits, waiting for a network miner to process it and stamp it into the official ledger.
Yeah.
And while you're sitting in that glass room, everyone can see your exposed public key.
And this is exactly where the quantum attack happens. A quantum computer spots your transaction in the mempool, looks at your exposed public key, runs Shor's algorithm to instantly calculate your private master key, and then broadcasts a brand new transaction using your stolen key.
Wait, but how does the hacker's transaction beat mine?
The attacker simply attaches a massive transaction fee to their forged transaction. The network miners, who are financially incentivized to process the highest-paying transactions first, will grab the hacker's transaction and stamp it into the ledger before your coffee purchase ever clears.
Oh my God.
Yeah. They drain your entire wallet while you are just standing at the cash register.
That is wild. It's a real-time, infrastructure-wide vulnerability. It's not just a problem for old, dormant accounts from 2009. Anyone who has reused an address or anyone trying to move money on a vulnerable network is basically a sitting duck.
Exactly.
So with the clock ticking toward 2029, the obvious question is, whether the entire digital economy is just waiting to be annihilated.
Well, thankfully, we are not sitting ducks. The conversation in the institutional space has rapidly shifted from panic to a highly complex engineering race. We're officially entering the era of post-quantum cryptography.
Yeah, looking at the recent standards, it's clear the defense mechanisms actually already exist. The National Institute of Standards and Technology, NIST, they finalized their post-quantum encryption algorithms in late 2024 and early 2025. So the math to defeat the quantum computers is ready.
We are even seeing it tested in the wild. Blockstream recently ran successful post-quantum signatures on the Liquid network, which is a secondary, faster layer built on top of Bitcoin.
Right, and even Ethereum has published a comprehensive transition roadmap targeting that 2029 deadline.
Because the fundamental challenge we face isn't inventing the new math. The challenge is logistical. How do you hot swap the foundational security code of a decentralized global network worth trillions of dollars while millions of people are actively trading on it?
You're essentially trying to change the engines on an airplane while it's flying at 30,000 feet.
Exactly.
And Ethereum's approach to this is fascinating. They're heavily utilizing a mechanism called account abstraction. To keep it simple, traditional crypto wallets are rigid. They're hard-coded to use one specific type of mathematical lock. Account abstraction upgrades your basic wallet into a programmable smart contract.
Right. By decoupling the user's account from the hard-coded signature scheme, the network can mandate an upgrade to post-quantum locks without forcing millions of users to manually migrate their funds to entirely new wallets.
The wallet itself becomes adaptable.
Exactly.
So what does this all mean for you, the listener? It sounds like if you're investing in digital assets right now, this completely flips your risk model upside down.
Oh, totally. Evaluating a digital asset or even a tokenized real-world stock is no longer about looking at marketing hype, community size, or, historical price charts.
Right.
The ultimate metric for survival is something researchers are calling cryptographic agility.
Cryptographic agility, meaning the capability of a digital network to rapidly, seamlessly, and safely swap out its underlying security protocols without fracturing the entire ecosystem.
Exactly. It's investing in the picks and shovels of cybersecurity. Giant institutions aren't going to pour billions of dollars into a network just because it's fast.
No way.
They are going to demand absolute proof from custodians, wallet providers, and infrastructure developers that when 2029 rolls around, their assets won't be drained in the mempool by a quantum machine. Networks paralyzed by infighting or slow governance will face a massive exodus of capital.
Which brings us to the final, perhaps most compelling layer of this entire deep dive. Even if a network possesses perfect cryptographic agility, they still have to confront an unprecedented governance crisis.
The abandoned coins.
Yes. We mentioned earlier that millions of Bitcoin are vulnerable. Specifically, there are roughly 2.3 million vulnerable coins that are completely dormant. The owners likely lost their private keys, threw away their hard drives, or passed away.
Right. So if the network successfully upgrades to post-quantum security, those 2.3 million coins are left behind, sitting in the old vulnerable vaults. They can't be upgraded because the owners aren't there to authorize the transition.
Wow.
And that is exactly the problem. When the quantum threat fully matures, those abandoned coins become a massive systemic hazard.
Because if a quantum hacker methodically drains those 2.3 million dormant coins and just dumps them on the open market, it would utterly crash the global price.
Yes. So the network community faces a seemingly impossible philosophical choice. The Google white paper actually highlights this exact dilemma.
The community has to decide what to do with someone else's property. Do they implement a hard fork to simply burn those 2.3 million coins, effectively destroying them to protect the network's overall value?
Or do they attempt some sort of regulated digital salvage operation, where the network seizes the dormant funds before the hackers can get to them?
But seizing or destroying someone's funds violates the absolute core ethos of decentralized digital money. It strikes at the heart of the promise that no one can touch your wealth but you.
It really does. The political warfare over how to handle these abandoned coins might actually create more volatility and network splits than the actual quantum computers themselves.
I hadn't even considered that angle. You aren't just taking on the technological risk of cryptography. You're taking on the extreme political risk of how these decentralized global communities govern themselves during a literal existential crisis.
You're betting on human coordination just as much as you are betting on mathematics.
This has been an incredibly revealing journey through the new mechanics of money. We started by examining the massive upgrade to Wall Street's plumbing, carrying down the old intermediary treatment plants and replacing them with instant peer-to-peer smart contracts.
Right, and we saw the undeniable momentum of tokenized assets achieving regulatory legitimacy, unlocking billions in frozen collateral for institutional giants.
But we also illuminated the mechanical dangers of that speed. The IMF's warning serves as a crucial reminder that a 247 financial system without deep liquidity and automated circuit breakers is simply a blueprint for uncontrollable flash crashes.
And hovering over all of this is the ticking clock of the quantum threat. The realization that brute forcing a lock is a thing of the past, and that exposed public keys in the mempool are just sitting ducks for advanced physics.
Yet, the defense is already being deployed. The race for cryptographic agility is actively separating the resilient networks from the obsolete ones, leading us towards some of the most difficult governance decisions in the history of finance.
The intersection of these forces is completely redefining what it means to hold a secure asset in the 21st century.
It really leaves us with a profound concept to ponder. As traditional Wall Street rushes to put its real-world wealth onto blockchains for unprecedented speed, and as the very blockchains race to rewrite their foundational code to survive a quantum computing breakthrough, we are witnessing the absolute fusion of finance and cybersecurity. It makes you wonder, are we rapidly approaching a reality where a global bank's most valuable asset isn't the gold in its vault or the cash in its balance sheet, but simply the agility of its cryptographic code? If the blueprints to the master key are already being drafted, perhaps the only true wealth left is the speed at which you can change the locks. Don't forget to subscribe and hit that like button.